Briefly on the legal side, the content of this video is for educational and informational purposes only. It does not constitute investment advice or a recommendation to buy. All analyses, models, and strategies represent personal opinions. No guarantee of accuracy or completeness is given. The full disclaimer can be found at the end of this video and in the video description.
Axel, welcome back to Learn for Finance. Today we need to talk about every investor's favorite topic, ETFs. Cheap, simple, broadly diversified. It sounds like the perfect risk-free way to prepare for retirement. So why are some experts suddenly sounding the alarm?
Hello, Lisa. Because this blind trust is the greatest danger. Imagine, you get into a state-of-the-art, comfortable coach. All the other passengers are relaxed. The journey is smooth. Only one thing is strange. No one is at the wheel.
Okay, that's a strong image. But passive investing has democratized the market, hasn't it? Lower fees, less gambling.
Short term, yes. But it has changed the engine of the market. In the past, analysts would assess a company's value before buying. Today, every euro flowing into a passive ETF automatically buys the stocks in the index. It doesn't matter whether the company is good, bad, overvalued, or undervalued.
Like a robot at the supermarket checkout, just placing everything on the conveyor belt without paying attention to the price or quality?
Exactly. And when millions of robots buy everything at the same time, what happens then? Prices rise, completely detached from the true value. Investors see the rising prices and think, wow, the value of the companies must be exploding. But that is a misconception, and this is very clearly visible in a chart from Bank of America. It shows the capital flows over the years. Active funds are losing volume massively, while index ETFs like the S&P 500 are attracting ever larger sums. The red line for passive inflows is literally exploding. But what do you actually get today when you invest in the S&P 500? 39% of the performance comes from just 10 stocks, mostly from the AI sector, Nvidia, Microsoft, Apple, Meta, Google, Amazon. The rest, 490 companies, account for just 61%. That is no longer a broad market portfolio. It is a lump with an AI facade.
The famous difference, price is not the same as value.
Exactly. But this logic is drowned out by a loud mantra. Buy and hold. Time in the market. Cheap and widely spread. All of this sounds wonderful. Until the day the bus has to take a sharp turn and everyone suddenly realizes, oh, there's no driver up front.
And this sharp curve, what could that be? You often talk about demographics. What happens when the baby boomers start needing their money for retirement and sell their ETFs?
Then the exact opposite of what we've seen in the last 20 years happens. Suddenly you have millions of sellers, but who is going to buy all of that?
The active investors hunting for bargains?
There are hardly any left. That's the problem. The counterpoint, which says, wait, this stock is now dirt cheap, I'll buy it, has been systematically pushed out of the market. Instead, the following happens. Massive ETF sales force the funds to sell stocks blindly. Prices fall. Investors who have learned price equals value see the falling prices and panic. They sell even more. This is the doom loop, a self-reinforcing downward spiral.
Phew, okay, that sounds terrible. But why should the boomers even sell in panic? Everything has gone perfectly for them so far.
Because a second, even larger wave is heading our way, Lisa. And it is called artificial intelligence. In the coming years, we will see a massive increase in productivity, but also higher unemployment, because many routine tasks will be automated. If a recession also occurs, it will become really uncomfortable.
Because people then need money and have to rely on their reserves.
Exactly. And now the $52 trillion question, because that is how much the US stock market S&P 500 is currently worth. How does an investor behave who has invested blindly and passively in the market for years, when he suddenly loses his job and at the same time hears everywhere that the markets are completely overvalued anyway. His capital is in a driverless bus, and if he has to get off, there is no brake, only the emergency exit.
But that only concerns the investors, doesn't it?
Unfortunately not. This is the great reversal of our time. In the past, a strong economy led to high stock prices. Today, high stock prices create an apparently strong economy. Consumption, property prices, lending, everything depends on stock market valuations. If the stock market crashes, it drags the real economy down with it.
A crash in the S&P 500 is therefore a crash on the main street.
In the worst case, yes.
Axel, honestly, that already sounds quite like a crash profit. Are you trying to scare us? I mean, there are plenty of finance YouTubers out there who gain popularity precisely with such scenarios. And honestly, from our last video, I know that Learn for Finance is exactly not that. No desire to be right at any cost.
And that's exactly why I appreciate you, Lisa. You are honest and critical. And yes, you are completely right. In my last video about Novo Nordisk, I clearly stated, we don't want to be right. We want to understand risks. Nur, this is exactly where the part from the Novo video comes into play, where I talked about the price decline and risk management. It's not about market timing, but about protective mechanisms. What I am saying today is a warning, not a prophecy. The risk-reward ratio in the market simply no longer fits. By the way, I also addressed this in the August update on seasonal stocks, where I recommended a strategically higher liquidity ratio. This completes the circle, and we are back in our bus. If no one is driving at the front, then I at least need an airbag so it doesn't completely crush me.
Thank you, Axel. That was important and clearly right. Okay, but now to the crucial question. What exactly should I do if I don't want to just sit blindly on this bus? Is there even an alternative?
Yes. And this is the biggest opportunity in decades. It means anyone who still takes the trouble to read financial statements and truly evaluate companies today has a huge advantage. The passive market systematically overlooks opportunities. Quality stocks are often dragged down, misweighted, or completely ignored.
Like at a huge flea market, everyone rushes to the stall that shouts the loudest, while at the edge, the true treasures remain undiscovered.
A perfect analogy. And finding these very treasures is our mission at Learn for Finance. In an overvalued market, there are still individual stocks that are fairly or even undervalued. But you need a clear strategy and the knowledge not to give up emotionally when prices fall. And that is exactly what our fundamental stock analyses are for.
The notorious 20-minute videos.
Yes, they are the exact opposite of blind investing. They are knowledge, calmness, and sovereignty in a world full of panic. Also summarized, passive investing is convenient, but potentially dangerous when the driver is missing. For whoever invests blindly, they leave their fate to the masses. And whoever thinks they are safe just because everyone is on the same bus could be terribly mistaken.
If you don't just want to be passengers, but also want to navigate yourself, then you know what to do.
What do you think? Have ETFs really made the market safer, or just more convenient and riskier? Share your opinion in the comments.
And if you don't want to miss any more videos where we show you how to become a pilot yourself, give us a thumbs up, subscribe to the channel, and activate the bell. Oh yes, Axel, before I forget. You didn't just shoot your tips on stock market valuations from the hip, did you?
No, I managed it without cold. But this is part of our new content area, technical stock market analysis, which we have in planning for you, so it's worth staying with us. Learn for Finance. Become a passenger to a pilot.
Disclaimer: the content on the YouTube channel, Learn for Finance, is for educational and informational purposes only. All analyses, quantitative models, strategies, data preparations and content presented reflect solely personal opinions and interpretations. There is expressly no individual investment advice or recommendation to buy, sell or hold financial instruments within the meaning of Section 32 of the German Banking Act, KWG, or Section 85 of the German Securities Trading Act, WPHG. The information provided does not replace professional financial, tax, or legal advice. The channel operator assumes no liability for the accuracy, completeness, or timeliness of the content. Viewers make investment decisions independently and at their own risk. Past performance, simulations, or forecasts are no guarantee of future results. Important note: investments in financial instruments involve significant risks, including the total loss of capital. Please consider seeking independent advice from qualified professionals before making any investment decision.